So, for those of you that are watching us on YouTube, it might look like we are
Into the Christmas season.
festively dressed for Christmas, but we are actually festively dressed for the IRS and tax season.
Favorite time of the year.
Yes. So, I think Jade is the tax refund elf.
Getting a refund.
And I am the, what is it called? Tax payment elf, I
Yeah,
guess.
that's what I had to do
tax
this year.
Tax penalty elf. Gathered, we are going to be talking about taxes and divorce. Oh my goodness, this is like a really fun one.
Yeah, get out the party poppers and get ready into this.
Yes, this will be great.
I think we were talking to our producer. He goes, I can't wait to listen to this one. This is going to be, I'm trying to work out how you're going to make this fun. It's like, so are we.
Yeah, let us know. Let us know what you think later.
Yeah, that's right.
All right.
So, but yeah, what we're going to try and talk about here to make it a little bit of fun
with some smiles.
Yeah, really understanding those tax implications of, division of assets, also looking at alimony, child support. And when we talk about child support and alimony, we're going to be talking about divorces after 2018.
So we'll talk about that in a second.
Yep.
We're going to talk about tax filing status options during and after divorce, actually.
Yep. And we're going to look at strategies for minimizing tax liabilities in divorce settlements.
Yep.
And a big disclosure.
Big reminder. We are financial professionals. We are, I swear.
Yeah.
But
that's
different. Yeah. That's different from being a tax advisor. We are not tax advisors or professionals. So all of the stuff we're going to talk about today is general in nature. And we strongly encourage you to hit up your CPA, IRS enrolled agent, tax preparer for specific advice around your situation.
And we'll probably say that at the end just to give it a nice bookend, wouldn't we?
Yeah, just to make sure you don't forget.
Yeah. And compliance will be happy. So
yes.
Yeah. So why are we talking about taxes?
Because as financial professionals, I think we made our own mistakes during our own divorces.
That is a good point there, yeah. So.
And if we financial professionals made mistakes on this, we're really hoping that you normal folks that are not financial professionals or, not the CFO spouse, we're trying to help you out here so that you can do this correctly.
Correct. Because when you think about it, it's not just like a yearly tax return where there might be smaller little mistakes. We're talking about dividing off all your assets. And if it's been a marriage for 20 years, there's house equity to be divided, quite healthy retirement accounts. That's some big mistakes that can be made. Yeah.
Yeah.
Could be made.
Big price tag.
Did I say will?
I don't know.
I don't know. I tried to say like maybe.
Okay.
Anyway. So there was a survey that was conducted by the National Endowment for Financial Education, or the NEFE, and it found that 47% of divorced individuals reported that they did not fully understand the tax implications of their divorce settlement before finalizing the agreement, which is kind of crazy. And I guess we fall into that category ourselves.
Yeah, we were part of that 47%, I guess.
Yeah, so hats off if you're the 53% then.
Yes. Thank you for doing that math correctly.
Well, math I do good, so.
All right, so this highlights a common issue.
Yep.
So that among people going through divorce, there's a significant number that fail to grasp how their various decisions in the moment, such as alimony, property division, and retirement accounts, can impact their tax situation in the present and in the future.
Yeah, I was going to say definitely into the future.
It's the gift that keeps on giving. It's not a Christmas episode. It's an IRS episode. Anyway.
That's right.
All right. All right. So first thing we're talking about, understanding the tax implications of asset division, alimony, and child support after 2018. So why do we keep saying after 2018?
Because there was a different set of laws before that. And we're assuming if you're listening to this, you probably haven't already had your divorce back in before 2018. Look, if you have, great.
Thanks for listening. Thanks for your support.
But you might be on your second one. So, all right, okay. Yeah,
so if you're on your second one, new rules.
That's right.
Yes,
third marriage.
Or third.
Yeah.
Or fifth.
Yeah.
Okay, so yes, this information is meant for people divorcing now or soon or in the future. but definitely after 2018.
Correct. Yeah.
All right. So first one, asset division. Look, basic concept. Not all assets have equal value. Let's give some examples, some of which we're going to recycle from previous episodes.
You've definitely heard this one. You know, 100,000 Roth is not equal to 100,000 in a 401k.
What is that? I don't know what that is.
What?
Any of it?
A Roth?
What does it
401k?
mean? Yeah, this is like alphabet soup. What is
that?
Okay. Okay.
All right. So a Roth is an after-tax account that goes tax deferred, and then so long as you meet certain requirements, gets pulled out tax-free.
A retirement account.
Yeah.
So these are both retirement accounts.
All right. Okay.
Kinds,
All right. Thanks for leading me down there. Yeah. And then a 401k is kind of like the opposite. It's
a pre-tax 401k.
Yeah. It's, tax deferred or pre-tax money that goes tax deferred, and then you have to pay tax later on.
Yes.
Yeah.
So why is that different? So let's say I'm 65 and I have $100,000 Roth and I have $100,000 pre-tax 401k. And I take a withdrawal of 20,000 from my Roth. Do I get 20,000?
You do, so long as you meet those criteria.
Yeah. Yep. How about if I take 20,000 from my 401k?
You're going to be paying taxes at your ordinary income tax rate.
On the 20K.
So
that means I'm going to get something less than 20K.
Yes, that's right.
Yeah.
So the tax rate starts at 10. Yeah.
Yeah. So I might get, I don't know, like 15K or something.
Yeah.
Something.
It depends. Yeah.
Yeah, it depends. But basically 20K is not 20K withdrawal from a 401k.
So that's just one part of it. There's the how they're taxed differently. But then you've also got, we've spoken about it beforehand, eligibility. Now there are such things as a Roth 401k, and but which doesn't have an income requirement to it. But typically a normal Roth that people are contributing to, there's an earnings limit where you can be phased out. So if you're a high income earner, you might not be able to qualify to, be making those annual contributions for a Roth. So, imagine if it was 100 or 200,000, that's a pretty nice, opportunity that for the high income earner to get some tax-free money versus having to pay taxes later on at most likely a higher tax rate too.
So meaning that maybe you try to negotiate for that if you're the higher income earner or at a higher tax bracket. So if you or your spouse have or had a Roth as part of this joint balance sheet, as the higher income earner, that's potentially pretty valuable to you if you end up with that asset.
Yeah. Or if you're the lower income earner and the higher income earner is trying to say, hey, I'll give you 100,000 from my 401k or traditional IRA, but I'll take your Roth though.
You got to equalize that.
No.
Well, it's not no, but like instead of if they want your $100,000 Roth, maybe you take 120 of their 401k.
Yeah, you're going to have to look at your taxable income, what it's going to be like, when you maybe need to take it out.
Yeah. So trying to equalize it. So it's not, I'm not saying 120 is exactly what the 401k equal is to the Roth, but there's some calculations there to equalize.
And by the way, I wasn't saying no. I was kind of going to say no before you doing that. Think about the tax, consequences of that. Okay.
Yes. Yeah. And these are just little concepts that show you that, if you have anything but the most basic of divorces, probably better to do it with help than do it yourself.
All right. What's another asset that's not counted the same then?
All right. So that's retirement accounts. Let's talk about the brokerage account. My brokerage account that I have I don't know.
Oh, your Tesla and NVIDIA in.
And my Facebook, now Meta, but I bought it in 2005 or whatever.
Yeah.
And it cost me, I bought it for $200 and now it's $20,000.
You're such
I'm just
a visionary.
Bragging. I'm bragging.
Anyway, they paid you to take it.
That's right. That's right. I got in early.
Yeah.
That's nice. It's $100,000 now.
Yeah.
Right. But maybe I bought all the stuff inside for $10,000. Yeah. Or your spouse did.
So what are you saying by that then? Like, if I sell it, don't I get all that tax free?
Do you get $100,000? No. You have to pay taxes on the gain.
All right. Now, how is that taxed though?
Depends. So it could be long term.
What counts as long term?
Anything that has been held for over a year. So if you do have that Facebook Meta stock from 2005 or whenever it IPO'd, that's long term.
Okay.
And that's at a lower tax rate, but I'm not going to quote what the rates are because they could change. So if you listen to this 5 years later, it could be something else.
Yeah.
but it's generally lower than a short-term tax rate. So if I bought NVIDIA, I don't know, 8 months ago.
Yeah.
And it's,
which you didn't, but yeah.
I didn't, no.
So you probably don't know what the price of it was.
I have no idea. But let's say I bought it 8 months ago and it's 1 million times over now.
Yeah.
And they sell it tomorrow. That's a short-term capital gain, tax much higher.
Yeah. So, you know, we're talking about like these brokerage accounts. So, you know, Joe's example was 100,000 and, you know, the alternate is taking 100,000 lump sum cash.
Mhm.
They're not equal because 100,000 cash that's your cost basis. That's
cash.
There's no taxes on that 100,000 cash.
Mhm.
Whereas you've got to take into account that capital gains or that appreciation in that brokerage account.
That's already there. Now, look, maybe you want that brokerage account because you're like, yeah, Meta is the future, and you want to keep it growing, and it's going to grow a bajillion more times. Maybe. But we're just saying, at the moment that you're divorcing, you gotta figure out the actual value at that point.
Correct.
Factoring in those potential capital gains, especially if you have an inkling that you might have to sell this stuff anyway because you need money right after the divorce.
Yeah, especially maybe if you've somehow been able to score that house without considering properly, can you afford it?
Yes. So moving on to the next asset. The house, the home.
Yeah.
Condo, house, co-op, whatever.
Roof over your head.
Roof over your head that you own. Different, similar cost basis issues. Cost basis meaning, what did you buy it for? So you have this $100,000 house. Let's just stick with $100,000.
Yeah.
$100,000 house, but you bought it for, I don't know,
50,000.
$5,000.
Yeah.
Monopoly, 5,000. You got to factor in, okay, I want the house, but what if you find yourself needing to sell it immediately because you're like, oh, shoot, I need some money. I need to move. Now, all of a sudden, you have to sell the house and pay taxes on that gain that you didn't think about because you were just thinking at the moment, I want the house. But more on that later.
Yeah.
We'll talk about that a little more in a bit.
Because, there's definitely there's
some more considerations.
Yeah, that's right.
All right, moving on. Alimony and child support. So, again,
since we're recording this podcast after 2018, we're in the 2020s now. So
sorry to ignore the audience that got divorced before 2018.
We're going to assume that all the listeners are, didn't get divorced, prior to 2018.
Yeah. So this is stuff, divorces post 2019 or 2019 and on.
Yeah. So under current law, alimony and child support is not tax deductible to the payor. Okay. So the person paying it, and it's not taxable to the receiving party.
Right. So the person receiving these payments, it's not taxable to them. Therefore, you don't need to put it on your taxes.
Yeah, that's right.
Your income taxes.
Which is a nice little,
one less thing to put on your tax return.
Yeah, that's right.
So that's pretty black and white. The payer pays the taxes on the support. The payee does not pay the taxes.
Yep.
Receiving the support.
Next thing that we want to kind of touch on there is, I guess, the different sorts of tax statuses that
filing
statuses. Yeah. During and after the divorce there. So obviously during the divorce, if you're going to probably file as joint.
Or married filing separately.
Correct, that's right.
Yeah.
But if you get divorced before, obviously December 31st, you've got to still be filing as a single person for that tax year.
It's an active situation. You're filing joint or married filing separately. After divorce, you're done. It's over. It's formalized. You're single.
Head of household, yeah.
Well, as in you're single person again.
Yeah.
You will be filing single or head of household.
Yeah.
Okay. And I guess this is assuming, of course, you haven't remarried. So we're not talking about that either.
Yeah.
All right.
So what if you've got kids, though? Because, obviously there's certain benefits that you can claim the kids. Can both parents claim the kids?
So, maybe. I like being non-committal. So maybe.
Yeah.
I'm just kidding.
But not in the same year, though.
No.
Yeah.
Okay.
Right.
So basically, if one parent is the main custodial parent, they can file head of household and claim the kids. And custodial parent for IRS purposes means who had them the most nights.
Correct. That's right.
The non-custodial parent will file a single. Okay.
And some couples alternate.
Like if you have joint custody, what if you're 50-50? There is no custodial parent technically.
Mm-hmm.
Okay. So you'll need to discuss either during the divorce process or, with some kind of agreement, post who gets to claim who or what each year.
Yeah. Which I didn't do properly in my divorce.
So
yeah.
This can be spelled out in the divorce decree, but maybe that means you need to read your divorce decree.
Mm-hmm.
Okay, so Jade.
Yeah. So, yeah, and that's something that I learned later on there is like, oh, hang on a minute. I thought we'd be alternating and stuff like that. Or maybe I just didn't give it much focus and attention at the time there because with everything else going on there.
Mm-hmm.
And it wasn't until later that I was like, oh, wait, can we be alternating this? And it's like, well, I really don't have a right to be asking that.
Why?
As well. Because it wasn't in the, I didn't ask for that in the divorce decree.
So did your divorce decree say that your ex could just file?
Yep. Yeah.
Could claim your child every year.
Yeah.
And you didn't read it.
Well,
read your divorce decree.
I think I read it, but it didn't fully make sense.
It didn't
I
click.
did read it. But
it didn't click.
Yeah.
Yeah. All right. So for me, and this is kind of subject to negotiation sometimes, right?
Mm-hmm.
So I have 2 kids. So we agreed that he claims one and I claim one.
That makes it easy.
Yeah. And I know of other parents that, one will claim them this year, one will claim them next year, and they alternate. So, but this is definitely something to keep track of because it's nice to claim the kids on your taxes and get those tax deductions.
Yeah, because you can't do it forever. So
yeah. And if you two can't agree, so basically if you two are technically 50-50 and both of you are squabbling about who gets to claim the kids, then bust out that calendar and count the number of nights that each person had the kids, and whoever has more days wins.
Yeah,
but that's
I don't like that approach there because then people are going to be bickering, going, well, let me take them for an extra night now. It's like, come on, with that ulterior motive of like going, actually, I'm going to try and claim them versus like masking it with, well, because I'm happy to take them. Nah, I've got no time for that BS.
I'm just saying, not everybody has amicable divorces like we do.
Yeah, I know.
But technically speaking, and I hope it doesn't come to this, count the damn number of days on your calendar if you have to.
Yeah.
I hope it doesn't come to that. I don't think I could count.
And is that nights? Or,
nights.
Yeah, nights.
Sorry, nights.
Yeah.
Overnights.
Because you could split days and there could be half days.
Right. Or they can have them for 6 hours. And it's like, what does that count for? So overnights.
That does sound messy though. I'm glad neither of us have to do that.
Yeah.
With our exes.
I will say that. Yeah, for sure.
Yeah.
All right. So strategies for minimizing tax liabilities and divorce settlements.
Yeah.
I mean, this is the fun stuff.
Get your pens and paper out. Let's take down some notes.
All right. We did cover this a few minutes ago, some of it, but worth discussing some more.
Yeah. So, I guess we got dividing the assets during a divorce doesn't, necessarily result in a taxable event for like
immediately.
Yeah, that's right.
So you got to think for the long term when negotiating, because immediately, probably minimal tax events, but later on you got to think.
Yeah. So I think a good example of this would be maybe that spouse who's really fighting hard to keep the primary house or the house.
Or even vacation home.
Yeah. And, they maybe haven't fully crunched the numbers by working with a professional on whether or not they can actually afford to keep it long term.
Right. It's not just about the value of the asset that you're keeping.
And all that they've factored in with their negotiation is that value of the asset without thinking of like long term, can I keep this for a longer period of time?
Can I afford the annual property tax of $20,000 a year when I make $30,000?
Because if they're forced to have to sell it, there is, obviously some, deductions that they get to claim and stuff like that. But there could still be a considerable amount of taxes, especially here in Los Angeles and California. Property prices are quite high there. They could be on the hook for quite a lot in taxes there. And maybe if they had actually, maybe spent a bit more time doing their due diligence or talking to a professional, they would have been able to maybe negotiate or at least have that come up in conversation going through their divorce process, correct?
Right. So, for example, again, examples just because we live in high property value state. Let's say you've owned your property for a number of years with your spouse. So long term, definitely several years.
Mm-hmm.
each of you jointly, right, can have up to a $250,000 capital gains exclusion, up to $500,000 if you jointly own it.
Yeah.
I did not think of this when I got divorced. So we didn't factor in the fact that I lost my $250,000 or his $250,000 exclusion. So then now I have to pay for that tax if I sell. And perhaps I could have negotiated some of that.
And I think you even heard it didn't even have to be keeping him on for 50% though. It could be
a
really small percentage number there. Once again, talk to a professional on that one there. But
yeah, because there's ways to do it where, okay, maybe you keep your spouse on. If you think you're going to be selling within a couple years or a year or whatever, maybe you keep your spouse on for just a little bit, like a few percentage points, just to keep that capital gains exclusion relevant.
Yeah.
But now, I'm going to have to pay taxes on that $250 if and when I sell.
Yeah.
But again, like just going back to the property taxes too. Oh, yay, I got the house. I got $500,000 from my settlement. Oh, shoot, I have a $20,000 property tax bill every year.
Yeah, that's not going away.
That's not going to go away. Yeah. And maintenance. Oh, shoot, my heater broke.
And utilities. And
there's a leak in my roof, you know. But I guess that's not taxes. So if we're sticking with taxes, okay.
Costs.
Property taxes.
Okay,
but
fair enough,
But yes, just factoring in, it's more than just the asset sometimes. So that's why you have to think a step ahead, a few years ahead, right?
Same thing happens when you're talking about like a brokerage account, correct?
Yes.
When you've got that unrealized gain that hasn't been taxed yet. Remember, you're not going to be paying taxes on that until you sell.
Yes. Like that Google stock that you've owned for decades.
Yeah.
That is where, you bought it for $2 and now it's a gajillion dollars. Yeah.
And as Joe said, like it could be at a more favorable tax rate. So that could all be fine, but you just want to make sure that you're considering that.
Yeah. Keep it in mind.
Yeah.
Yeah. Maybe you believe in Google and it's going to keep going up. That's great, but just make sure you've thought of everything. Something about, the employer retirement plans. So let's just say, you're a listener and you're like, okay, I don't care about the house. We don't own a house. I don't care about the Google brokerage account. We don't have Google.
Yeah.
All we have are our 401ks. And I know I'm going to need to withdraw some money. We're both going to have to withdraw some money, but that's all we have. What's a good way to kind of strategically do this so we can save a little on taxes?
Well, there's something called a QDRO, which we've spoken about beforehand, yes. So qualified
domestic relations order.
I think. That's right. Yeah, and that's where you get to peel out that portion of those funds before you do get divorced, correct?
As part of the divorce.
As part of the divorce, where then there's some tax benefits for doing that there, where you're not, because otherwise, if you do it post divorce. Then there's tax issues that have to be taken into account. Yeah.
So for example, if both of you are younger than 59 and a half and you really, if you withdraw from your own retirement plan, you're going to incur a penalty. So in addition to paying income tax on your withdrawal, you're going to have to pay a 10% IRS tax penalty for withdrawing early. So let's just say both of us have $100,000 in our retirement plans. So there's really nothing to split, right? Because we're even.
Yeah.
But one or both of us, we know that we're going to need to withdraw some money from these plans. So as part of the negotiation process, for example, you can agree to give me 25% or 25,000 of your 401k, and I can agree to give you 25,000 of my 401k, right? Which still nets zero, right? So why even do it? Well, you do it because if you do that, and then you have to take a withdrawal from the 25,000 that you receive, you're only going to have to pay income taxes on that and not that 10% penalty.
Yeah.
So it's just like this little loophole that's really important to know about if you know you're going to need that money.
And I forget the time. There's a amount of days or some requirements around that. I can't remember that specifically.
Again, refer to your professional.
Yeah.
Whew. Wow. I don't know. Like, was that Christmassy enough? I mean, IRS-y enough?
Well, we can go ho, 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 and we can then... oh, no, wait. It's meant to be IRS-y, not...
IRS-y. Okay. Well, hopefully we've steered you more towards the green and not towards the red.
Yeah.
Yeah? But it's time for... Divorce, this or that.
What have we got? I wonder if it's a festive one or not.
Yes.
Or a tax one.
All right, loaded question, Jade.
Yeah. Is there a disclaimer with it?
Divorce, this or that. Yes,
Yep.
there will be a disclaimer. Divorce, this or that.
Yep.
Would you rather keep? You're negotiating your settlement.
Mm-hmm.
Would you rather take a $300,000 pre-tax IRA or a $200,000 Roth after-tax IRA?
I'm gonna have to do math on the fly here. So yeah, that's a tough one because I would have to look at like my tax situation, how much I'd be paying in taxes there.
Oh, boring.
I know, but my gut feeling, right now, just based off my situation that I can think of, without factoring in my exact tax rate, because I had some stuff going in the last couple of years where it increased my tax rate. I would go with the 200,000 Roth because we're both, and I'm up it where I can't do that. It's the standard way of doing a Roth contribution there. So anymore. I would, and part of my long-term plan is like maybe living part-time in retirement in Australia. So I've also got to think about like tax laws over in Australia on how they would view different sorts of those retirement accounts.
Okay.
So I would obviously consult and I'll do calculations, but that's my gut feeling. I'd go with the Roth.
Okay. So yeah, I felt like that was a very loaded question, and we could do our own another podcast episode just on that.
Calculating it out, yeah.
Yeah. So disclaimer: consult a tax professional.
But what would your gut feeling though be? I guess.
Well, I feel
because really it's more of a gut feeling.
I feel like my gut feeling for my situation is perhaps the IRA, the pre-tax IRA, is probably worth more right now. Net of taxes, potentially slightly worth more than the $200,000 Roth. But I think I just want the Roth because I know it's nice and clean and I'm going to grow it. And since I love investing, I'm going to grow it aggressively. And I'm going to know that everything in there is going to be tax-free for me in the future. Yeah. And I don't have to worry about strategizing,
doing Roth conversions,
tax distributions in the future and things like that. So it's just nice and clean. So I think if they were close to equal, and even if the IRA was maybe worth a little bit more right now because of my tax situation, I think I would go for the Roth based on the optimistic, my optimistic opinion that perhaps I'll be earning more in the future. And my taxes that I would have to pay on IRA distributions are going to be higher. All
right. I think we kind of ended up at the same one there together then. That was a fun one there.
That was not fun. Anyway, sorry. I guess divorces aren't fun. So divorce this or that. This one, not fun. Okay.
I could see some people's heads going, wait.
All right. So we were talking about divorce and taxes.
Yeah. Taxes and divorce.
Yeah. So first we were talking about tax implications and the ramifications around asset division, alimony and child support, and again, alimony and child support after 2018.
That's right. We also spoke about exploring the different, tax filing statuses during and after divorce.
And then also strategies for minimizing those tax liabilities in divorce settlements, i.e. think long-term.
Yeah. And just a reminder, we are financial planners, advisors, and we are not tax professionals. So make sure that you consult with your CPA, your IRS enrolled agent, your tax preparer, fill in the blank.
Because specific advice around your situation, because we don't know you and we don't know your specific situation. We'd love to know you, but we don't know you.
Yeah, that's right.
Yeah.
So hopefully maybe you got some value out of this. Maybe it wasn't a fun episode, but it's definitely hopefully
kind of necessary for tax season. Yeah.
It's a big number though, that you could be paying in taxes. So it's definitely important.
Yeah, exactly. So I'm Jo.
I'm Jade, and we'll talk to you in 2 weeks' time.
All right, see ya.